You may be the new Treasury Secretary. Better watch out what you say. I have a mea culpa. I have to say, from years 2001 to 2003, when interest rates were their lowest, I had my best years in this profession. I was on steroids. So, well,
I like that.
So when I work with the Wells Fargo Bank, who does commercial and investment loans there, he described the Wells Fargo attitude towards commercial property lending now, and he calls it a zero-defect culture. So what I thought about that, what he was saying is that to get a commercial property loan, multifamily commercial loan through their system, it must have zero defects. So his message was, it has to be really clean. They've got money, they want to make loans, but no wrinkles at this point on the loans to get through their system. And that's kind of what it feels like to me as I field calls and process loans as a mortgage broker, income property person. You know, things, you can't have explanations and stories and but this and but that. It really has to be together, and then there is money there at a 120 debt coverage ratio for apartments, and for commercial, probably 125 debt coverage ratio is where the banks sit right now. The really good news that I'm seeing now is affordability, and it's really becoming I think it's kicking in, it's happening now, and I'll talk about that in a second. Another good news aspect of where we sit right now are ARM loans. If you have an ARM loan already in place and you're sitting there with your ARM loan on your property, whether it be a home or commercial, it is wonderful. I mean, you could have 3% interest rate accruing because of where the indices sit now. Particularly, let's look at, the one-year Treasury is below 1%. Many loans are tied to the one-year Treasury. The money rate scoreboard shows apartment loans based upon the current one-year Treasury and a spread of 235. And if you add the one-year Treasury, which is 0.56% yield, to that spread of 235, you have a 2.91% interest rate. So, if you have an ARM loan, if your clients have ARM loans that were not floored, just allowed to float up and down with that index, they're accruing interest below 3% on their ARM loans. If you have a home equity credit line, and I have one that's 0.75% below prime, and prime's 3.25%. That means the interest rate on that equity credit line is 2.5%. Really attractive rates. Now, my message is, do not get complacent, please, with these ARM loans, because they're not going to last. At least those of you that think that inflation will come back at some point with all this stimulus and all this spending by the federal government. That means that these ARM loans are going to go up in these out years, whether it's a year from now, 2 years, 3 years, 5 years. But I think once the economy gets its traction, and the $64,000 question, of course, is when that's going to be. But when it does happen, the interest rates, short-term interest rates, have to go higher. So I think we all have to bite the bullet and convert ARM loans over to fixed rate, or at least intermediate 5, 7-year, 10-year terms, or 30-year terms at some point, or you stand the risk that your wonderful 3% current loan becomes 9% a couple years down the road, so watch out for that. Of course, we're waiting for today. Tim Geithner, who's the new Treasury Secretary, right now, I think, is announcing his new bailout plan for banks. It's the revised or revamped bailout plan. So the other shoe supposedly will drop today. We'll hear more about that as we exit the RIAC meeting later. President Obama made a presentation yesterday about the stimulus package, and what he wants is productive stimulus, I guess. What we all want is productive stimulus. So that means that some of the examples he uses, if we're going to spend, and we are going to spend as a nation and deploy money out to create jobs, it should be in productive jobs. Example, we're going to weatherize, perhaps, buildings so that they'll be more efficient, we won't use as much energy to heat them and cool them. That's productive spending. Want to take schools that are outdated, that are dilapidated, replace them with good schools so that kids will learn better. That's productive spending. We want to do, talking about road improvements, we'll move people and goods faster, more efficiently. That's productive. Now, one of the things he did talk about yesterday, and he was in Elkhart, Indiana, and it's the RV capital of the country, I guess, where they produce the most RVs. He said people can't buy the RVs, they can't get financing. Now, so my question is, on this one I go, I don't see how that's productive. Because RVs, they're wonderful, great, you have one, wonderful. But I don't see where that's productive. It's leisure, it's fun, it's enjoyment, but it doesn't fall into the same category that I would see as weatherizing a building so that you then spend less on it to heat it. So we have to be judicious in the categories we pick to stimulate. Some are productive and some aren't. We've got to stay away from the non-productive. And the skill here, the management challenge is defining productive. And that's a subjective term. Let me finish up with what I think is pretty exciting now. You go through this god-awful, horrible period that we've gone through in the last couple of years, all this pain, but what comes out of it? Well, right now I think what's coming out of it is affordability. You drop 40% in home prices, the result is home prices are affordable. Well, right now, just to quantify, in Orange County, and by the way, I've gotten these calls just anecdotally, and I'll bet everybody here has too. He's starting to notice that buyers are taking, there's interest, and I'm just talking about the home market now, not commercial, but I'm getting them. But a $500,000 house now, which was probably $750,000 a couple of years ago, nice neighborhood, good home in Orange County, if you put 20% down, so that's now a $400,000 loan, $100,000 down on $500,000, you're borrowing $400,000. Your payment at 4 7/8%, and Betty mentioned we may have 2.9% loans. I personally don't think that's going to happen myself, because somebody's got to pay for that. It would be an artificial rate, and so I guess we as a country could buy down the interest rate. But I'm not holding my breath. But at 4.875, your principal and interest payment is $2,117. PITI, principal, interest, taxes, and insurance, is just under $2,700,000 on a $2,700 a month on a $500,000 home. To qualify for that, you need about $80,000 a year. Two-income family, $80,000 a year is reasonable. It's out there. If you have a job, I guess that's the question. Well, and we're all going to take hits, by the way. Whether in real estate, you're going to be selling, if you sell houses, instead of $750, you sell at $500, so the commission is 2/3 of what it was, 3 years ago. People are going to get their salaries frozen and take salary hits, and I think we're going to see a lot of that. You keep your job, but you're going to take a 10% or 15% hit, and I think people can live with that. If the sense among all Americans is that we're all getting a hit, but it's across the board. If we have that feeling, I think we'll embrace, as a nation, the things we're going to have to go through. So, $80,000 a year, you can buy in a nice neighborhood, a nice